What if I told you that the world's most valuable companies, Nvidia, Apple, and Tesla, could all lose 70% of their value at the same time? Not in some distant dystopian future, but in 2025, within months from now. You might think this is impossible. After all, these companies have dominated their sectors for years. Their products are in almost every home, car, and data center. They are the crown jewels of the stock market. But history has a way of humbling even the mightiest giants, and the patterns we're seeing today are eerily familiar. The same forces that toppled the titans of the past are quietly aligning again. Stay with me, because by the end of this video, you'll see why the market's glittering facade is cracking, and why even companies like Nvidia, Apple, and Tesla are not immune. Setting the stage, a history of market giants and catastrophe. To understand why 2025 could mark a historic crash, we need to rewind a little. Throughout modern financial history, market crashes have followed a surprisingly consistent pattern. Overhyped sectors attract massive investment. Speculative bubbles form, often fueled by cheap credit, low interest rates, and investor euphoria. Key triggers, sometimes a single event, sometimes multiple stressors, cause panic. Massive sell-offs follow, leaving even the strongest companies scarred. Think of the dotcom crash of 2000. Companies like Cisco and Yahoo were considered untouchable. Their stock prices were inflated by hype rather than fundamentals. Then reality hit. Profits lagged behind expectations, debt piled up, and the bubble burst. Investors lost trillions. Or the 2008 financial crisis, when giants like Lehman Brothers and Bear Stearns collapsed under their own leverage. Entire systems, mortgage-backed securities, derivatives, and banks that were too big to fail, failed spectacularly. Now, consider the present day. Nvidia, Apple, and Tesla are different in one key way. They are not just companies. They are symbols of the modern economy. But symbolism doesn't protect stock prices. In fact, it makes the fall more catastrophic when it happens. Origins of the 2025 crash. The seeds are planted. The seeds of this potential crash were planted years ago. Let's break down the key elements. 1. Excessive valuation. Nvidia, Apple, and Tesla have been trading at sky-high price-to-earnings ratios for years. Investors were betting not on profits today, but on the promise of a future revolution, autonomous vehicles, and next-gen technology. The problem: futures are uncertain, and markets hate uncertainty. 2. Over-reliance on a single trend. Nvidia's AI chip business is booming. But a single technological disruption like a breakthrough competitor or a regulatory hurdle could instantly cut revenue projections. Apple relies heavily on iPhone sales and high-margin services, while Tesla's valuation is heavily tied to EV adoption and battery technology. One misstep in any of these trends could trigger cascading sell-offs. 3. Macroeconomic pressure, inflation, rising interest rates, and global supply chain disruptions are quietly squeezing corporate profit margins. Investors may not see the immediate impact, but the market prices in the future, and when rates rise, high-valuation stocks are the first to fall. 4. Market psychology and speculation. Retail investors, institutional funds, and hedge funds have all piled into these stocks simultaneously. This creates a fragile market, where sentiment, fear, or greed can swing prices violently. The rise, a decade of exponential growth. From 2015 to 2024, these companies didn't just grow, they soared. Nvidia became synonymous with AI. Its GPUs were at the core of machine learning, cloud computing, and gaming. Apple's ecosystem grew stronger every year. iPhones, iPads, Macs, Apple Watch, AirPods, and a booming services segment. Tesla became the poster child for sustainable energy, with its Model 3 and Model Y dominating global EV markets, and Elon Musk capturing the imagination of millions. Investors saw triple-digit returns and assumed that growth would continue indefinitely. Every quarterly earnings beat reinforced the idea that these stocks were must-holds. The result: a bubble within the tech and EV sectors, inflated not just by revenue, but by perception, hype, and momentum. The breaking point: what could trigger the crash? No bubble lasts forever. The critical question is, what triggers the fall? Here are the likely catalysts. 1. Regulatory shock. Governments around the world are tightening regulations on AI tech monopolies and EV subsidies. Imagine if key AI applications are suddenly restricted, or if Tesla loses crucial incentives in major markets. The sudden realization that growth may be capped can cause massive sell-offs. 2. Interest rate hikes. Rising rates make borrowing more expensive. Companies with high debt, Tesla and Nvidia included, see profit margins shrink. Investors shift from high-risk growth stocks to safer assets like bonds. 3. Supply chain disruption. Geopolitical tensions in Asia, semiconductor shortages, or shipping crises can halt production. A few weeks of disrupted supply can translate into lost earnings guidance, shaking investor confidence. 4. Market psychology and algorithmic trading. The modern market is heavily influenced by automated trading algorithms. A sudden drop in stock price can trigger cascading sell orders, magnifying a correction into a crash. The fallout? A domino effect across the market. Once these companies start falling, the effects won't be isolated. Here's how it could unfold. Nvidia falls first. As investors panic over AI hype failing to materialize or competition emerging, Apple follows. As tech stocks historically move in tandem, and high valuations make it vulnerable to investor flight. Tesla drops, fueled by EV sector concerns and the broader tech downturn. Together, these three companies account for trillions in market capitalization. A 70% drop in their value could erase more wealth than the 2008 financial crisis in nominal terms. Retirement accounts, mutual funds, and ETFs holding these giants would all be affected. Other sectors are not immune. Financial institutions that lend heavily to these companies, or funds with concentrated positions, would suffer cascading losses. Consumer confidence would decline, tech spending would slow, and the stock market could enter a prolonged bear market. Failed fixes. Why history shows recovery isn't guaranteed. Governments and central banks have tools: interest rate cuts, liquidity injections, and market bailouts. But history shows these are not always effective. Dotcom crash. Monetary easing didn't prevent many tech companies from going bankrupt. 2008 crisis. While banks were saved, everyday investors lost trillions, and trust in financial institutions was permanently damaged. Modern algorithms. In 2025, automated trading could accelerate the sell-off faster than any human intervention can react. Even a well-intentioned government bailout may not stop a market panic if investor sentiment has fully shifted. Once fear dominates, rational arguments and policy interventions are often too late. Modern parallels. Patterns repeating in 2025. Let's connect the dots between past crashes and today's market. 1. Tech overvaluation. In 2000, the Nasdaq peaked at 5,048. By 2002, it had lost 78% of its value. Nvidia, Apple, and Tesla show similar relative overvaluation against their earnings. 2. Concentration risk. Just as a handful of dot-com companies dominated market indices in 2000, today's S&P 500 is heavily weighted by tech. A simultaneous fall would ripple through the entire market. 3. Speculation, fueled by cheap credit. Low interest rates, for years, encouraged leverage and margin trading. Margin calls could accelerate the crash once prices start to fall. 4. Public hype versus reality. Social media and retail trading apps amplify euphoria and panic. Fear spreads faster than ever. The same psychology that fueled GameStop in 2021 could now work in reverse on mega-cap tech stocks. Shocking data points: Nvidia's PE ratio in early 2025, approximately 90x forward earnings. Compared to 25x historical tech average, Apple's market cap, over $3 trillion, a 70% drop equals $2.1 trillion lost. Tesla, over 50% of its value tied to projected global EV adoption, not current earnings. When combined, these three alone represent over $5 trillion of market value, enough to destabilize global stock markets if panic spreads. 3 clear takeaways. 1. Diversification is no longer optional. Even the biggest tech names are vulnerable. Holding only mega-cap stocks is risky. Spread exposure across sectors and asset classes. 2. High valuations hide extreme risk. Growth expectations are not guarantees. When valuations are disconnected from fundamentals, even small shocks can trigger massive losses. 3. Market psychology drives crashes faster than facts. Fear, hype, and automated trading algorithms can accelerate declines beyond rational expectations. A warning: open-ended thought. The 2025 stock market crash may not be a question of if, but when. And it won't just affect Wall Street, it will affect pension funds, savings accounts, retirement portfolios, and everyday lives worldwide. The companies we assume are too big to fail are only safe until investors' sentiment changes. History doesn't repeat exactly, but it rhymes, and the patterns are clear. Nvidia, Apple, and Tesla are at the center of the next potential rhyme. Call to action: if this video gave you a new perspective on the fragility of the markets, hit the like button and subscribe. Share it with anyone investing in tech stocks or holding large portfolios, because knowledge today can save you tomorrow. And leave a comment. Do you think 2025 will be remembered as the year the giants fell, or will history surprise us again?